Good morning, everyone, and welcome to episode 21 of Mortgage News Live, coming to you from London town. Thank you for joining us, and thanks as always to our sponsors, MPowered. Well, we have another intriguing show lined up this morning where we will be discussing the market and the remortgaging opportunity over the next couple of years with another gorgeous gaggle of panelists. It's been a very strange couple of weeks, with the new government's honeymoon period being short-lived as they discover a 20 billion hole in the country's finances and now have to deal with a bunch of Neanderthal idiots rioting on the streets. The good news is that the sun is shining, the Olympics are in full swing with Team GB going great guns, and yes, finally, we have had a Bank of England base rate cut, with the MPC voting 5-4 in favour of a cut. Swap rates reacted with some huge falls, with 2-year money briefly falling below 4% and 5-year money now back down at 3.5%. Rate cuts are incoming from lenders, but it may not be until after the holiday period that we see them really ramp up, or down rather, in the simmering rate war. However, MPowered, yay, have cut rates this morning, so do make sure you check out those new bad boy rates. All eyes also across the pond in the US, where there seems to be a sense of panic selling as the US economy shows it may not be as robust as they thought. The Fed could possibly make an emergency 0.5% cut, while the Japanese yen continues to strengthen and cause its own issues. Stock markets and cryptocurrencies have borne the brunt of this, but will it be a short-lived correction or something deeper? Global events and escalations in conflict do not help. However, the UK property market seems to be braced for a more buoyant end to the year, but with the budget now scheduled for 30th of October, cue a raft of Halloween headlines, anything can happen. Now, against all this backdrop, we're here to talk about things we can actually do to make a difference. And so I shall stall no longer and introduce my lovely guests. First off, we have Mega Srivestra from who's the National Account Manager of 27 Tech. Welcome, Mega.
Hi, Monty.
We have the new social media sensation, Carmen Green, mortgage advisor at Express Mortgages. Hi, Carmen.
Good morning.
Gindi Mathoon, the founder of Create Finance, who keeps beating us at awards, apparently. Hi, Gindi.
Good morning, everybody.
And the inimitable Paul Lewis, who is the head of partnerships at Mortgage First. Hi, Paul.
Good morning, everyone.
So welcome all of you to this lovely day and this lovely thing. So we have finally had a base rate cut. Swap rates have fallen pretty dramatically. And how do you expect this to filter through? We're seeing some lenders cut now. And how have your clients reacted to it? Have you already had loads of clients phoning up and going, yay, rates are down. Can you please review my mortgage you got for me? Carmen, what's it been like for you?
Yeah, exactly as you say. It's great. It's the excitement. And sometimes I sit there and think, yep, I'm very aware. Base rates dropped. Yep, we're going to get you some hopefully better rates. It's on my to-do list, that never-ending to-do list. But for sure, it's excitement, and we like that. And for once, it seems like it's really positive news, and it's what everyone's been hanging on for, really. So even though we were sort of hoping it was going to happen, it's actually become real now, and I think that's, yeah, for sure. It's sparked some excitement, and we're hoping that will then continue and it does pull through to the mortgage rate, because it doesn't always. And I think that's one thing we have been saying recently, is that a base rate, unless you're on a tracker rate that tracks the Bank of England base rate, they don't necessarily match up. So you're not going to get that same 0.25 reduction. And I think that's the thing I'm having to explain a little bit now to the clients is, yes, we're hoping that will reflect, but it's not an imminent reflection, and it may not be that you get that whole 0.25% reduction on your interest rate, and just explain that without having to sort of go into too much detail about the swaps and how that works, because that's confusing. So we can't sort of go too much into that, but it's just trying to explain the difference between those two things. But they were in line, and there was times where that wasn't sort of in line. You had swaps coming down, but base rate going up, and all those things. So, but yeah, excitement for sure.
And Gindi, from your clients, do you see? Do people understand that this is a fall, but are they getting overexcited? Do they think that actually it's going to fall dramatically now?
I think so. Well, there's a couple of ways of doing this really, because I think the media are really good at selling stories. So if someone's read something in the news, I'm not necessarily saying the mortgage media, I'm talking about the Daily Mail and so forth and so forth. So I get a lot of clients telling me, well, we've got another base rate cut pending. Who knows? Monty, you just alluded to a few world factors that could have a play on things. There may be a base rate cut, there may not be a base rate cut, but I think the sentiment that we share at Create Finance is that the rates will probably get lower in August once again. So you can kind of react and change someone's rate today. However, I think what we're doing at the moment is let's see how the next couple of weeks pans out, because it's great like MPowered to drop their rates today, but some lenders will obviously follow suit later on down the line. So for the sake of like not changing the rate today and changing the rate in a couple of weeks' time, I think we're saying let's wait a couple of weeks. We're quite optimistic that the rates will probably drop once again over the next few weeks. But hey, listen, I don't have a crystal ball at all. They could go the other way.
Yeah. Paul, you've got a crystal ball. How's it been for you guys? And similar, same kind of stuff.
I completely agree with what Gindy's saying, and I think bad news sells better than good news. So that's obviously what we're seeing at the moment. Lots of positives that you'd mentioned already, Monty, but I think it has landed. I think that people are aware of it. The phone is certainly it's busier than it has been. But the same comment that Gindy's just made there, does that mean that because it dropped or because the increases were so, I guess, frequent, is that then going to be exactly the same regarding dropping? Because we keep hearing that the market is going in the right direction. Does that mean that there's going to be another cut coming soon? I agree. I think the rates will probably, well, listening to some of the lenders that were in yesterday, I won't say who they were, but wanting a little bit of face time with our advisors within the next 2 to 3 weeks normally gives you an idea that something's coming. And that there's going to be some cuts, and that sort of lenders, the top 5, top 6 lenders. So it is coming. I just think we're in for, again, we'll play it by ear and see as to what's what. When we jumped on the call initially, I asked Carmen exactly the same question: is the phone busier for you guys? Mainly for the reason being that again, it's holiday time. The kids are off 6 weeks holidays or 7. That some have got people flying in and out of the country, or UK based holidays. Possibly the mortgage isn't the priority that it would have been, and a nice distraction. I think people are just kind of muddling through and getting through that holiday season, I think.
Yeah, no, absolutely. And Mega, what sense do you get from your broker partners around what's going on at the moment?
I mean, we already started this year with a very high increase in searches overall. But if we look at from Thursday last week, Friday and Monday, the search volume's gone up hour by hour, which is, again, as Paul said, is quite surprising to see at this time of the year, where Fridays are generally a bit more quieter if you look at historically. And then Monday, which was now school holidays, we did not really expect that volume, but which is great to see. So it can tell us that brokers are obviously looking at products, and the reason they're looking potentially is getting all those phone calls from their clients. Another important thing I would say, or interesting thing to mention, since Thursday, we I would say made about 85 rate changes on our system, which is about 20,000 products plus. So you can only imagine like how quickly lenders are, requesting changes on this, and how much alert all the advisors need to be just to ensure they can still maintain the quality of advice.
Just on that, Meg, I think Carmen, Paul, Monty will probably agree here as well. We have quite a lot of deals where deals expiring end of August. end of September. So we're revisiting a lot of our client book, because we, as a business, we operate a promise where we'll review your mortgage 6 months before the deal lapses, but we'll keep an eye out on the rates until your fixed rate ends. God, these clients are absolutely happy. Like, you would have thought this kind of 6 months ago, like the rates will probably start coming down to these sort of levels. And yeah, what a great time for them. Obviously not so great because the payments are gone up, but it's not so much of a burden at all.
Yeah.
It feels like good news, doesn't
It's
it? Even if it's not
Definitely,
quite.
Yeah.
Yeah. So just a reminder to everyone watching: if you you can leave a comment on LinkedIn or ask a question. Raza said there is downward pressure from global markets. The swaps are down further, so it'd be interesting to see how this all plays out. There's so many competing forces at the moment. But Megha, actually, just on the amount of the searches that are going through the sourcing system, are you seeing any trends there? Are you seeing a brokers now looking more for 2-year fixes or trackers, or as opposed to longer term fixes? Are there any changes there?
Yeah, I think 2-year deals appear to be the favorite at present. If you look at comparison to last year, they're already up by 2%, I would say. So if you look at overall searches, 2 years accounted for about 43% of search, which is quite huge, versus 5 years. And we actually have seen a decline on 5 years. So if we compare to last year, it's about 3% decline. Now, that made me wonder, because obviously this year we started, market was a bit more stable. And now when we start to see that reduction, I think a lot of clients may still want to wait. And as Jim did referred before, they may want to see another cut before they would want to, sign up for a deal. But when it comes to tracker, it's a bit different, because again, I saw a bit of decline in tracker as well. So they accounted for about, say, 9% of searches this year so far, which is 2% less than last year. So tracker doesn't still have that love from the market. And it could be because generally they're quite expensive, or say slightly expensive compared to fix. And whilst there's a potential to gain the rate dropping, but this is already loaded into the initial rate, which I believe is make them a bit more less appealing. Going one more thing to that is another thing I always say about products are really available in the market. Now, if you look at what products, tracker is about 6% compared to about 85% fixed rates products that's available in the market.
Yeah.
So
that's really interesting stat, that is.
Yeah, and that's what I always felt, because if we don't, it's just again like demand and supply, really, isn't it? Where obviously lenders do look in what do we need to offer, and even after having very unstable market, we only still have very low percentage of tracker products available.
Yeah, it's a massive number crunching exercise.
From a broker's perspective, then, are trackers? It doesn't sound like they're the new black this season, although I thought they would be. And actually, is it more about, once we see 5-year fixes predominantly starting with a 3, are we going to see a switch back to sort of that 5-year fix market again? Is there because at the start of the year, it's sort of, we got down to, I think, 3.7% on a 5-year. We might get back down there again, it looks like. There'll be more lenders having 3.99 5-year fixes. So what are most of your clients looking for at the moment? Carmen, go on.
Yeah, it's a real mixture. I think for sure they're wanting to at least consider and look at all of the different options. So there's interest in tracker for sure, but then usually when you then compare that in front of the client to say, look, this is the tracker rate. These are the benefits of having the tracker, particularly in this type of market, where obviously if you do think the base rate's going to continue reducing, then this is how that could then look for you. But when you then put it in front of a 2-year fix, which like Mega was saying, actually the difference in the interest rate is quite a bit still at the moment, they then just go, well, actually, is it worth the risk? I am paying a premium for that product, for the tracker. So when you then actually do the number crunching on it, they go, actually, I don't know if I want to take that risk, because we've learned, if anything, over the last few years, it can take a U-turn at any point. And there's so many uncontrollable elements of that, external global issues that can impact that. So I think they're definitely showing interest in trackers, but actually when it comes down to it, a 2-year fixed is pretty popular at the moment. I think 5-year, when people were worried about the security, now they feel like there's a lot more trust in what's going to happen with interest rates. They can predict a bit more confidently that rates will come down, or at least that's how everyone feels at the minute, it seems. So yeah, 2-year fix, very popular. It goes very quickly. So we're actually reviewing 2-year fixed rates in 18 months. Well, we suggest you review it 6 months early. And if you think back to the last 18 months, blimey, how quickly has that gone? So actually it gives them, they do think, okay, it's fixed for 2 years, but gives everything a chance to settle, which is hopefully what we're all hoping for, I think, is that everything will settle, rates may continue coming down. And for sure, the gap between the cost of a 2-year fix versus a 5-year fix has also closed. There was at one point for quite a while where there was quite a big gap between the 2-year and 5-year. So I think people that were opting for 5 years, say a year ago, in the last sort of 8 to 12 months, they were almost feeling forced to do the 5-year fix in a way because they couldn't afford that 2-year fix. The monthly payment was such a big jump for them that they had to just take whatever the lowest rate was, or felt they had to take the lowest rate because that was all that they could afford. So it wasn't necessarily, it was a choice always, it's always a choice, but they were sort of more directed to that 5-year fix because the 2-year fix would have stretched them so much on affordability that it would have caused potential financial worry and all those sorts of things. So as anything, it's even more personalized now as to which interest rate suits. And it's also, you still have to go back to the basics of, well, what are your plans over the next 2, 3, 5 years? Yeah, interest rates are obviously very topical at the moment. Everyone's interested in what's going to happen. But what's happening in your life too? Is it suitable to do a 5-year fixed if you're going to move in 2 years and you want flexibility in 2 years to review everything again? So I think sometimes you have to sort of, and I often find myself reminding clients is, okay, but also what's going on in your life. It's not just about the rates and what's happening there, or don't feel forced to make a riskier decision of maybe a 2-year fix if actually as a person you are quite risk averse and you will be worrying about it for the next 18 months in case something happens. Those 5-year fixed rates would still be more suitable for those clients. So I think because it's topical of interest rates, people can be forgetting the other things that sort of make you choose a particular product. It's not just about the rate. But for sure, if the rates do come down a bit more, then I think longer fixed rates, because people like security.
Paul, what do you think?
Again, probably echo exactly the same as what Carmen said. I think another thing to factor in there is where the customer is on their mortgage journey. Are they at the beginning? Are they just starting, first-time buyers? We've got a new government in place that are pledging to be building X amount of hundreds of thousands of new properties. As a parent, only speaking personally as a parent, I would personally prefer my 2 children, 2 boys, to be going in on a 5-year deal to know that they're secure. So that would just be parents' advice, not mortgage advice, parents' advice. So again, I think just to echo everything of what Carmen said, I think she covered it off quite well, didn't she, Gindy?
Yeah, I agree. Just on the trackers as well, if you look at the tracker rates at the moment, the tracker rates obviously aren't as attractive as a fixed rate. So you have to question how far do the trackers need to come down before they get cheaper than the fixed rates. So you question, right, base rate cut, you got 0.25% maybe later on this year. Don't quote me on that, by the way. It's only what I read in the media. So how far realistically do you think they can come down? So you've got to think, 18 months ago, I think discounted rates off the standard variable rate were the popular trend then. Then all of a sudden, you saw the base rate keep going up. So we've got a few clients that are coming off the discounted rates now. They're all like, right, fix me. Literally, fix me onto a mortgage. Don't put me on a discounted rate at all. So, but who knows? economists got a tough job, unfortunately, predicting the next 18 months, 2 years. Us in this room here probably know a bit more than economists, and you got to go what's right for you today.
Yeah.
I like that. We know more than economists. We do. It's all. That's why my economics degree is an art. It's Bachelor of Arts, not science. I've always said that. It's definitely an art, not science. Yeah, it's quite interesting, actually. I just did a little search on 27 Tech. There you go. And who comes up top in remortgages is MPowered. There you go. Look at that. Remo 5-year fix, 4.19. So, yeah, it's quite interesting. Now, I want to get on to how clients are feeling now, because we're still seeing a lot of people come off their very low long-term rates. And I get the sense that people have actually anchored themselves quite quickly to the new rate environment. And the reason they've done that is because now they're not worried that rates are going to be 5.5%, 6%, like they were just, in the sort of the few months after Liz Truss. Ugh, I can't even say her name now. It just gets me so angry. There's no one who gets me as angry as that. But anyway, so how are you seeing how are your clients reacting to it, Gindi, now in terms of coming off that lower rate and going on? Do you get a sense that actually people are dealing with it? Are they getting their look? The lights have gone out because I've been stand up and get the lights on.
Not pay electricity bill.
No, right, no, exactly. Hey, times are tough. So anyway, you know what I'm trying to say. How are you finding it with clients? Are you still having those tough conversations?
I know I've alluded to the media quite a lot. One thing the media has done is they have talked about the last 18 months, 2 years, since unfortunately Liz Truss meddled with our financial system, that the payments actually are likely to go up. So the media has sold that story well. So when we're obviously having the conversation 6 months beforehand, like Carmen is with her clients, we're preempting with the clients. Listen, we've been blessed for 5 years or so, probably 10 years, but 5 years on your fixed rate, paying a nice low rate of interest. Your monthly payments are going to go up. This is what you're looking at as your monthly payments. So we'll check in once again in a couple of months with you. But luckily now, so they're kind of preempting in the head, right? Okay, I realize my payments are going up. So what can I do to make sure that it's damage control? They might obviously look at sending that car back. They might be expecting some sort of pay rise of some sort. They might tidy up any credit commitment. So I think, although no one wants an increase in their outgoings at all, I think they're kind of aware that the payments are going up. So it's an easier conversation to have now.
I would agree 100% on that with you, Gindi. We went through exactly the same with energy suppliers. We've gone through exactly the same when it comes to filling your car up. Food, Lurpak being at the highest price it's ever been and whatnot. We've kind of gone through it. And I think, like I say, I think the media have done quite a good job for us already in preparing people. So it's kind of come as the final bit to kind of catch them. And that would be sort of my thoughts on it. And I think summed up quite well there, Gindi, really. Thanks to the media on this one, just this one.
Yeah, I agree. Yeah, I agree. And I think it's quite interesting when you see the demographic of client that also changes that conversation. So if you've got someone who was a first-time buyer 2, 3, 5 years ago that you're doing their remortgage, they've never been through that process before. They've never known a mortgage different to the one they've had, versus an older client who's been through different markets, had different mortgage products, has more of an understanding of finances in general, and they've lived through different types of interest rates. I think that's quite interesting, and the conversation with them is very different. And there's also other bits of the mortgage that you can change as well to sort of soften that blow if needed, potentially extending mortgage terms if that's suitable, possibly putting someone interest only. I mean, obviously it's very niche to each client of what actually is going to work and the risks around doing those things. But yeah, I think as a whole, they like I say, they're aware from the media that it's going up. But if you've had experience in that before, which is where I find that our experience, and I mean, I've been doing this 10 years, which you could say is a long time or a short time. But I think when I first started, interest rates were around about 4 or 5%, and that was normal. And it's trying to explain that sometimes to some people who hadn't realised that, and going, well, actually, these mortgage interest rates are okay. Yeah, we hope they come down, but this is probably more normal. Like you said, Monty, right at the start about it being that we've had a really good run of low interest rates, and this is a bit of a reality check in a way. But yeah, I think, like I say, I've not had anyone sort of madly surprised that their rates are going up.
Are you still seeing any of you seeing people use the mortgage charter and using that, and then coming to you and saying we've done that, taken an interest only for 6 months or something like that?
No, I don't think I've had anybody.
No, it's interesting, isn't it?
There was interest in it at the time, but I think, again, when you explain the pros and cons and the risks of it, it's like, okay, well, what can you do first? I think there are a lot of people, and perhaps just in my client set, might be different in other areas, but actually there were other things, like Gindi said, about reducing the car payment or sorting out your credit cards or not putting a holiday on a credit card and going somewhere cheaper and those sorts of things. I think, luckily, for a lot of people that I spoke to, were able to look at other means to sort of help out.
Yeah. So as broker, we've seen us doing a lot more work, a lot of getting a mortgage out for a client, and then rates change, then we've had to rebroker it and do it again. Often that's on a PT basis. And it's quite interesting. I just wondered if you guys are feeling that, are you seeing lenders fight more now to retain the clients directly themselves, or do you feel actually that lender partnership is still working quite well? And then also sort of a follow-up question, which may also frustrate you, Mega, is what do you think about some of the mainstream lenders who are now in effect hiding their product transfer rates from the sourcing systems themselves? And is that creating more work and more of an issue because they're doing this individual pricing? Mega, how's it from your perspective, all of that?
I think from my perspective, as a sourcing platform, but previously as an advisor as well. So if I put my advisor hat on, want my life a bit more easy. And I think the importance of sourcing system always been, you can, conduct your search in one place, ideally. And then not having visibility to some PT products for mainstream lenders obviously make life a bit hard for not only the advisors, but also for the clients, because obviously the time it takes and then your compliance work you may have to do, obviously is more time consuming. When it comes to the sourcing point of view, it's just like, we feel like it's just not giving our advisors the holistic view of the products, and then just leaving that gap of, go to the lender's portal and have a look of what that product can offer. Now, if I actually think again in terms of how the search is performing on the remortgage or even the PTs, we started the year really well. I mean, on PTs, it was really good in terms of searches conducted, and also on the remortgage. But then from May, say month on month, it just started going down for remortgage. And then on PT, I also saw like a decline, which again make me feel, is it because we're looking more on the remortgage side versus a PT? Or is it because it's the business going directly to the lenders? Or as an advisor, we just thought, doing a PT with your existing lender who may not display their PT products on sourcing is impacting that search volumes. So that's like, again, another thing which, as an advisor point of view and a market trend point of view, we may need to think. But saying that, again, July, we saw a quite increase in PT. And that could be purely because the rates may be coming to an end for a lot of clients. but it was quite a bit of hike. I think August will give us a bit more clarity in terms of how the remortgage performs against PT. Because as you all may know, another mainstream lender decided to remove their products from sourcing platform lately.
Yeah.
And that may make an impact. So I think August figures will tell us quite a lot.
Yeah. Paul, what do you feel about all of that?
It's a tough one, isn't it? I mean, you see, I'm not customer facing, or I don't broker any business, and I've never been a mortgage advisor. I think overall, from a reputational point of view, in as much as from a company stance, yes, I completely agree that it is a bit frustrating for the advisors that they haven't got clear sight of what they're up against, which is obvious. But on the other side of it, if it's right for the customer, it's right for the customer, and as long as the customer's getting the best deal, then that's kind of got to be where it's at. And if it's a case of you miss out on this occasion, keep them relationships in place to then re-engage with your client further down the line. But it is a hard one. I can completely understand the frustrations that advisors are feeling. And I agree with what Megha was saying there. I think we're going to start to see end of August, September. I think we'll start to see some kind of stability there, and hopefully advisors are happier. So that would be my take.
Gindi, I do remember talking to you at the Mortgage Strategy Awards, I think it was. We were talking about various things. I know I was probably pretty drunk, but how do you feel about that kind of thing?
I think if the broker originally sent a client to a certain lender, they should have first refusal on the product transfer. Ultimately, we were there for lenders during the pandemic, but ultimately we put that client with the lender as well. It's just like them lenders that steal your thunder when a client gets a mortgage offer, but they'll send a text first before you get the opportunity to ring the client to say, hey, we've got you a mortgage offer. Oh, it frustrates me. That's a topic for another day. But yeah,
it's the little things though, isn't it? I do understand, yeah.
There's certain lenders that do it as well, and it's so frustrating. And then when you ring a client, got the text message, you're like,
take all the glory.
That's it. It's taken the glory, and that's the fun part about the job. You want to hear the client's reaction. But ultimately, I think, Paul, I appreciate, obviously, you mentioned there that you keep in touch with the client and so forth and so forth. I think if you've done that transaction, it's easier to stay in touch with that client, because that client are probably inclined to go back to that lender once again. So for me, I think us brokers, we need the income. Ultimately, I think it's our client. I think we should have in control of offering the product transfer to the client before the lender does. That's my view on it.
Carmen?
Yeah, completely agree. I think what we're finding is on the ones where you do then get involved, the clients appreciate it massively by the end of the journey, but it's trying to explain to them and show them the value of having an advisor, even if it does end up still being that product transfer that you go to, but changing that rate over. There are some lenders that give you slightly different products via a product transfer if they come via broker, via direct. So you've got more options. I think two things have probably impacted that the most over the last couple of years. The first one is panic. I think a lot of clients have been panicking, and perhaps that's what's made them just click the button quickly to get that rate, because they don't know what's going to happen. And in the market where the interest rates were going up, then you absolutely can appreciate that, and they're worried that it's going to go the next day, and they panic press, and then they go, oh well, I've done it now, and that you potentially lose them that way. I think also they don't want to have to do all the paperwork if they come via an advisor. I mean, we do still gather all the paperwork to make that new recommendation. We treat it as if it's a new case. And it may well be that you know the client enough that there's certain questions you don't have to run through again, but they sometimes don't like to do that. So having the option to do it simply on an online sort of platform can entice them in that way. But I just think it's really valuable what a mortgage advisor does, and if the lenders can support that a bit more, I think that would be appreciated by us all, and would probably have better outcomes in general. So really agree with Gindi really on that, is that it's frustrating when they sort of take that relationship then direct, especially when you've done all the work usually in the first place. If they're a first-time buyer, for example, you've done all that work to build that relationship, and it's just they then go off and click a button and it's done. But it's the lender, if obviously as a consumer, if it's as easy as that, then great, go ahead and that's what they want to do. Not my recommendation, of course. I always advise people to speak to their mortgage advisor in any case. But yeah, it's a tricky one. It's hard.
I think the danger we see is, Graham's actually made a point, it's ridiculous that we have to log on to a case to find what rates are available. It's that little bit of extra work where, and I won't, because every lender listening will roll their eyes at, mention PT prop fees, but it's another piece of work. It's another thing we have to do. Yes, we do have to get the documents. There still seems to be this massive misunderstanding of what broker does on a PT in order to compare the whole of the market. There's still all that work. There's still that advice risk, etc., etc., etc. And I still see a lot of people just pressing a button when actually that's not the best option for them. They could have potentially reduced the term. They could have potentially done something else. They just go blindly into a rate that might not be suitable for them because they haven't gone through that advice process. So it's an interesting topic. Rohit said, I agree with that. It's the paperwork that is usually the key blocker and puts off clients who are looking at remortgage options from getting the best outcome from their circumstances. And we're in this world now where the lenders are saying, oh, it's so quick, it's so easy, just press a button. And actually brokers are saying, no, we want to give you proper advice. Send us your paperwork so we can give you that proper advice. And the two worlds don't really meet, do they? So I agree with you, Carmen. That key word there is getting the best outcomes for customers. And I worry that there are a lot of customers who aren't actually getting the best outcomes because they're just pressing a button. There you go. That's my just sort of soapbox moment. I'll shut up now. So I want to cover the buy. Just look at buy to lets a little bit, and the buy to let space. And I know I've talked to Paragon a lot actually about the amount of remortgage business and potential that is coming up in the buy to let landlord space. And it's been a hard market for landlords. And again, with rates falling, this could be a real opportunity for brokers to speak to landlords and speak to them about their portfolios. Maybe for the first time in a while, actually, there will be some options around them. Gindi, is that something you've thought through, create?
Yeah, so obviously over the last couple of years or so, lenders have got fairly innovative on the products that they're out on the market. So you got your lower rates with higher arrangement fees, and you got your higher rates with lower product fees. So what we're finding at the moment with these rate changes is that those rates that carry slightly higher product fee, well, because of the rate reductions now, you can actually go into a different tier, so slightly lower rate and a lower arrangement fee. So it makes it a bit more attractive then for a landlord. So yeah, we're seeing landlords fairly active in that at the moment.
Carmen, do you deal with a lot of landlords in that space?
Yeah, and I think it's a numbers game. It's a business. It's all about the finances. It's all about the figures for buy to let, because that's what it's supposed to be. It's in an income and an investment. So the figures have to work, and if they don't, then there's not much space for it for a lot of people, and that's how it's looked for a lot of people, sort of new landlords or the smaller landlords. It's not been working. So. And the minute those rates go too high, it's not profitable anymore. So why would you have it? And it's that sort of argument. But for sure, definitely we're able to do a lot more now, even just in these past couple of months. And that'll get better over the coming weeks to make it all fit. I mean, it depends on which area that you're in as to rental calculations. But I think also people are getting used to the structure of those products with the high rates and the high fees, low rates option. they are working, but like Indy said, people don't like those products still. It's still a horrible thing to look at this great big fee, even if the overall cost is the same, which is another part of the number crunching that you have to do. But yeah, for sure. And again, it's that excitement, and it's that, oh, this might work now. I've got lots of clients, so I predominantly deal with residential mortgages. My colleague Rachel does the majority of the buy-to-let here, but I've got a lot of clients who have their residential and they're now wanting to invest. I've had numerous inquiries where people want to get into that space and into that market.
That's interesting.
But where you've been showing them the rates over the last 2 years, it's not really been either possible to buy what they would like to buy, or it's just not been profitable in the way that they want to. And if they've got their savings in a high savings account with the rates being high at the moment, that could actually be a better investment for them. But for sure now, I've got clients that I've sort of redone the rates for them on a buy-to-let because they're desperate to get onto the property ladder from a buy-to-let perspective and buy their first rental property. So we're redoing those, and it's starting to work, and I think that's great for the rental market.
That's really good to hear. Yeah, that's interesting. Go on, Gindy.
Yeah, I was just saying, it's interesting. Obviously, you say that as well. I think if you look at 6 months ago, if you look at the buy-to-let rates at 80% loan to value, they probably started high 6 or with a 7. And I was actually quite surprised when I looked a few weeks ago. And I've actually put some clients on this now as well. They start with a 5 now, so with a 20% deposit. So I think it's definitely going the right direction. So that 1.5–2% drop in the space of a few months is great. And fingers crossed, touch wood, they'll get lower.
And Mega, how are you seeing the buy-to-let searches? I hate the fact, by the way, I have to go onto page 38 in order to get a normal buy-to-let rate with a normal fee, rather than a wealth of hundreds of 7% fee, 9% fee, 5% fee. It is a minefield at the moment. But are there any trends there in the buy-to-let? Have you seen that increasing again?
Yes, actually, buy-to-let is I was a pain point for me for personal.
I can imagine.
So I'll tell you about the 27 tech side first. We started like in the beginning of the year, January, February. I think the trends are very similar. I would say from last year, with a decent volume of hits or searches we were getting. It slowed down about May, June, where quite dropped. So I guess people were waiting for about election, maybe things may change, or maybe the rate drop. But July changed the story. So I think July numbers are very similar to the numbers we saw early in the year. So it's going basically in line with what Jindy just said. So that's basically the search side. The personal pain is finding a mortgage which you feel is worth fixing, I would say, or even getting your remortgage. Last 18 months, I would say, has been very challenging. So I'm just talking about like as a perspective or a point of view of a small landlord where you feel, your rental properties need to work for you. But I believe a lot of landlords are in a place where their rental investments not really making them any profits. And I would say personally, a lot of people may be paying money from the pocket, just waiting to see the market may change. So every day, my first thing in the morning is go on my sourcing platform and say what rate changes have taken place and how much it changed my monthly payments potentially. So hopefully another rate drop, and then yes, I can finally remortgage.
Good. Paul, mortgage first then.
No, to be fair, one thing that I'd noticed, and bizarrely, I'd seen a report on this yesterday, and I was just going to ask Mega if you've seen an uptick in expat buy-to-let inquiries, because I think, again, since the change of government, stats had showed something like 9,500 millionaires out of the country, which is leaving an opportunity or potential opportunity there for an increase in expat buy-to-let. We've seen that because we can't do that through our normal network, but we've seen a lot of those cases that are now starting to go over to specialists first, which obviously is our specialist arm under Connect. I was just wondering if you've seen any sort of uplift or anything in recent weeks.
I would say me personally have not monitored the expat on the buy-to-let side. However, if I think about the criteria searches, which in a way do correlate with your mortgage searches, expats is normally top 3 searches over the last few months. So that clearly tells me that, advisors are looking are serving client age, and they need the clarity on expat, but that could be for resi and buy-to-let both.
Yeah, we're getting about 10, 15 inquiries a week on expat, just expat alone, which is unheard of since the start of the year. So
yeah, we've seen an uptick as well. It's definitely an interesting part of the market. Maybe we'll do one of those on. We'll do one of these on that coming up. But time is marching on. Time waits for no man or woman. What is nice, we've had a lovely message from Anna. And morning all, I'm relatively new to the mortgage industry. Getting my head around constant rate and product changes is intense. We know, it really is. Thank you for explaining things in such an easy way. Very interesting. Who doesn't love a debate on a Tuesday morning? We love a debate on a Tuesday morning. To be fair, I love a debate anytime, anywhere, any place. But I just want to end with any last words of wisdom to both brokers or borrowers alike in today's market. Mega.
I would say the rate changes has been more than ever. So when you advise, maybe don't stick to the rate before you place your application. Have a look around again, because them rate may don't exist anymore, or you may find a better deal for your customers. So as I said, 20K set product changes in the last 2 days. That's insane. So if you are getting your customers, just make sure you are up to date with your sourcing and your products.
Paul?
Exactly the same. Stay close to your lenders. Stay as close as you can. Be informed of what's out there, because it's all going to start to change very quickly. So Anna's in for some great fun if she's relatively new to the industry. So
yeah, and we love newcomers. So welcome to the industry.
Yeah,
we're a nice bunch, really. Speaking of nice bunch, Gindi.
I think we've got a rate war coming from lenders, because lenders are probably not lent out what they wanted to lend out. So I think the next 4 or 5 months will be very, very interesting. So brokers, roll up your sleeves. It's time to get to work.
Carmen, you started, you can finish.
Yeah, I agree with everybody else, to be honest. It's hard work for us, but it's what we do. We do it day in, day out. We know the market. We know what to expect. We get the heads up from lenders when changes are about to be made. So not only are we seeing it as it happens, we're seeing it slightly before, so we can sometimes act on that. But yeah, so just it's trying to be organised, isn't it? Where they get yourself into a process that works for you and your team as to how you're going to monitor all of that. At what point are you going to review things, and just be transparent with the clients as well, and reassure them that look, we know the rates are coming down. We're looking at it, and they may not feel the need to send through a new rate every time they see one come up on socials, which can be the case, which we know they're just trying to help, and it's all very topical, so it's great. But yeah, just you can do only your best. And Anna, if you're coming into this market, rest assured in the future you'll feel like the job is a breeze. So yes, good experience for sure.
It's a good experience. Although I'm 30 years on, I'm still trying to get. I'm not sure a bit about breeze.
There's always something, isn't it? There's always something making it tricky.
Yeah.
You must have started in your teens, did you, Monty? 13, 14?
No, that's far too smooth, Paul. Sorry. I don't deserve that. Have I got some kind of filter on? I don't know. Anyway, never mind that. Thank you to my wonderful guests. Thank you, Mega. Thank you, Paul. Thank you, Gindi, and thank you, Carmen. Some great conversation. And thank you to you all for watching. Now, we have started shouting out Star Broker of the Week at the end of each webinar. So please tag MPowered on socials when you've seen a broker go above and beyond, and you can nominate a Star Broker on the MPowered website. A big hello today. Hello to Dan Johnson at Barlow Irvin Financial Services. Dan's clients faced a tricky dilemma when their mortgage application was rejected after they had already agreed to buy a house, and Dan worked tirelessly to find a new product for them at the last minute, His clients commended him for his ultra-efficient approach, which helped them secure the home of their dreams. I love stories like that. Well done, Dan. That is what we do. Remember, we are bi-weekly, so we're not here next week. In fact, I'm in Corfu, so but back the week after with another amazing show. And remember, you can listen to all these on Spotify podcasts. If you've enjoyed it, I've been Andrew Montlake. If you haven't, controversially, I've been Tommy Robinson. Until next time, have a great week.